Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, October 25, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So it's wild out there. I get it. The market is somewhat tricky. We're going to go through everything tonight. Is a low in? Is it not in? What happened at the end of the day today? Why didn't we finish at the highs? Was there short covering? Was it enough? All those questions, we're going to answer the whole kit and caboodle tonight. The underlying theme is, and has been for several days, we're looking for a low. All right, so that's the underlying theme. We'll go through everything tonight, all the data, all the puzzle pieces, all the clues and evidence we can find. Let's start with the bigger picture and then work our way down from there. Before we do that, let me pause. Let me thank everybody for making comments under the video. I really appreciate the participation. Please continue to keep up the great work. It's helpful to the entire community. In addition, please hit the like button on the video and share the video with anybody that you think can benefit from this information. Okay. Back to the bigger picture. We're looking for a low. Does the low have to be where we were yesterday? No, it does not. Can it be somewhere in between where we were yesterday and 261, 262? Absolutely. Can it go all the way down to 261? Yes, it can. Either way, we're looking for a low. And at this point, it almost doesn't matter whether the low is in from yesterday or we go slightly lower. And I'm going to explain why, and I'm going to explain how to take advantage of that type of situation a little bit later on. Now, today was a pretty healthy up day. Now, at the end of the day, mind you, it wasn't as healthy as it was in the beginning and throughout the day, right up really into the close for the most part. Then the shenanigans began after the bell with earnings releases from Intel, Amazon, Google, and a whole host of other companies, but those are certainly three important earnings releases that can certainly move markets, and they are moving markets. We're going to talk about those. I'm going to get into the charts of those in a moment as well. But let's discuss today's activity. So first thing that my eye is drawn to is the candle that today developed at the end of the day. It's an inside day. We could have expected an inside day almost no matter what happened today because of the magnitude or the expansiveness of yesterday's candle. It's so wide that you almost have to expect an inside day today, of course, unless we were down again today. All right, that being said, why didn't we go up to test the top of the breakdown candle from yesterday? That's question number one, and the answer is relatively obvious. It's because the market wasn't as strong as it appeared to be throughout the morning and afternoon session. That's obvious now, I get it, but I'm going to explain further what I was looking at. And it's very obvious now that you can see the close. Look where the volume is as it relates to yesterday. So yesterday, the total volume recorded was about 178 million shares in the Spiders. That's pretty good volume, but it's not tremendous volume. We talked about it last night. It's not capitulation volume. I talked last night about the fact that we really needed to see a little more fear out here. We need to see a little more panic. Okay, but still, I would have been accepting of the fact that yesterday could have been a bottom because it satisfied what I was expecting on the downside in this correction. So regardless of the volume, the number was reached. Doesn't mean we can't go lower, but so far, I'm comfortable that a minimum downside target was reached. Now, we have an update today. So what happens is you would expect if this market was truly reversing, we would have had tremendous institutional participation, buying everything they can get their hands on. The shorts would have had to cover everything. There would have been waves of panic buying. And you know what? We didn't see that. What does that tell you? The bottom isn't in yet. Now, that's what it's telling me. Can the bottom be in? Yes, it can. But what I'm going by is how I interpret the information that the market is giving me. And how I interpret this information is that it's likely the bottom isn't in yet in the SPY. Fair enough. Do I still think the bottom's going to come in somewhere either from where we were yesterday or 261 in the middle there, somewhere in between? Yeah, I still think that's where it will happen if it hasn't happened already. Now, that brings me to another topic. At least from my perspective, one of the most efficient ways to make money in these periods of times is buying stocks. Whether you buy options on stocks or you buy the actual stock itself, that's up to the individual trader. However, let me go through my rationale why. Of course, before I do, we're all recognizing that it's certainly out on the risk spectrum as opposed to doing some other things, such as buying the indexes themselves and or buying exchange-traded funds. However, let me give you the other side to that equation. We started talking a little bit about it, maybe last night, maybe the night before. Not everything turns at the same time. Certain stocks in certain sectors will turn before others. Certain ones will turn before the market turns. Certain ones will turn after the market turns. It's all over the place. So therefore, what I like to do in situations like these is I like to select stocks where I can find very, very good, what I'll call long-term support levels. These are generally off the long-term charts. Minimum of daily, most likely weekly, and even in some cases, the monthly chart. So what I like to do is begin buying portions of positions across many different sectors. So I'm spreading my risk across many different sectors. I'm also spreading my risk across time. So I've already started to buy. You already know that. I've been jumping up and down on the table that a low is coming, a low is here, a low is nearby. I've been talking about the stocks. I've been showing you the charts of certain stocks. I got stopped out of a trade yesterday, so be it. I haven't got stopped out of other ones. Today was a big day. A lot of stocks got elevated today. The bottoming process is just that. It's a process. Sometimes it happens all at once and you get that quote-unquote V-bottom and everything takes off all at once. And other times the market's going to chop around for a while. It's going to back and fill. It's going to trick, trap, fool, and frustrate as many people, traders, and investors as possible. And then it's finally going to take off to the upside. But a bottom will be found, and I believe we're near. Therefore, I've begun the buying process, as you know. And so really cutting to the chase of my reasoning, and I'm not necessarily right or wrong, it goes to individual preference, but here's what I like to do, and I'm giving you the reason behind it. Let's just say, for argument's sake, I bought 10 different stocks, or at least a portion of 10 different stocks. Let's say the market goes back down tomorrow, and it goes back down on Monday before it finally finds the bottom. I recognize that the stocks I bought will go down with the market. Some will go down more than others. However, how about this? Today was a big up day for most of the day in a lot of the stocks that I've already purchased. Guess what? Already booked a little bit of profit on some of them because you have to. That's the prudent thing to do. Why did I do that if I think there are much higher prices coming later? Because I also know that the market doesn't go in a straight line. It's going to trick, trap, and fool investors and traders. And therefore, we're going to have rallies and we're going to have pullbacks. And therefore, on some of these names, I will trade around core positions. So if the market drops again and some of the stocks drop again, what will I do? I'll put back on the position I took off today for a profit. That's the way it works. It's called rinse and repeat. Just like the shampoo commercial. By the way, what a great marketing strategy that was. Nobody needs to wash their hair twice, but if you listen to the commercial and you wash your hair twice, you use twice as much shampoo and they sell twice as much. Pretty unbelievable. All right, back to business. Now let's go to the intraday chart. We'll start with the hourly chart. I want to point a couple of things out. When you look at the hourly chart, there's a couple of things that jump out at me right away. Again, this is strictly from a visual perspective. I want to know the first 1, 2, or even 3 things that my eye is drawn to because they're likely the important things on the chart. Just from experience, that's going to be true more often than not. So right away, I see 2 important pivots. I see this level up here, and I also see this right here, and then of course the bottom, which is a third, but I was talking about highs for a second. The bottom I see from yesterday there. So I see three important price levels. First thing I want to do is I want to take stock in how much the market has actually retraced from certain pivot highs and certain pivot lows. And this is something that's gone through in detail in the course at Lazy E-mini Trader. But what I want to do is, just from a visual perspective, I want to note that there looks like a retracement is going on. So then I will take the measurements and determine what is that retracement from both pivot points. And when I say both, I mean this one and also this one, and I'm using the pivot low from yesterday, and I take stock in where we are, and does that make sense? Is the market trading technically sound? And the answer is yes. Okay, I check off the box, on to the next thing. The next thing I take note of is, did we close above today an important area on the hourly chart? And the answer is, yes, we did. We closed above an important breakdown candle. So that's important. We're below it now, and I'm going to get more into that a little bit later. It's important to know that during the day, we did get an hourly close above that particular price level. That's important to me. Can it fail? Of course it can, but it's important nonetheless. Those type of things always factor into the equation. It's a puzzle piece. It's on the table. And by the way, just on a side note, I recognize that it may not be the ultimate low, but pretty much almost nailed the low to the penny yesterday based on this particular price level given out well in advance. So my only point in telling you that is, tell your friends. I'm just kidding around. All right, let's get back to business. Now, we had a pretty nice rally off yesterday's low. We tested, we filled a gap. This morning, we opened up higher. We filled the gap left open from yesterday's close to today's open, tested a little bit lower, and then took off to the upside. That's one thing. But now look, this is the after hours session. It's a little bit more dramatic when I go down to a 10-minute chart. So you can see what happened. We began selling the last half hour or so of the day, and that was kind of normal, not necessarily unexpected. No big deal. We were up a ton all day long. But now look what's going on. So here's a 10-minute chart, and you can see the following candle after the close was a big down candle. This was as a result of Amazon and Google. We'll get to that in a moment. So it'll be interesting to see what happens tomorrow. Is it a normal garden variety retracement using the earnings releases as the excuse to retrace a part of the move from the lows from yesterday to today's high, which was a retracement in and of itself? And if that's the case, then the low holds and we take off to the upside. If not, the low doesn't hold, but we do find low within a couple of days down in that zone we discussed before. So either way, it's no big deal. So what happened? Here's Amazon. You can see where we were at the close of the day. We were all the way up in this area around 1785, 1790, in that zone. We've collapsed down, currently trading, as I make this video, at 1660 and change. That's a big decline. That's going to hurt the tech sector tomorrow. Before we move on, here's a daily chart of Amazon. And just to give you the perspective of where we are, 1660, roughly, we're bantering back and forth, is down here. So we're at the lows from the other day right now. We're right at that 200 period moving average. So that being said, if that breaks below tomorrow, for example, and we begin trading lower, the next area is going to be down here at around 1580, 1570, 1590, in that zone. It's hard to pinpoint it when you're talking about a $2,000 or $1,600 stock. You're back to, do I have to nail it to 25, 35, or 40 cents? And you have to multiply that by 10, and that's the same routine in Amazon. So it's hard to pinpoint it to the dollar, but somewhere in that $1,580 neighborhood would be a very, very interesting level of support. There's also a gap down below that. So there's a lot going on down in that 1550 to 1575 area. Certainly all the way down to 1500 if that were to happen. I'm just saying. Another culprit is Google. So Google reported earnings after the closing bell today. Google closed the day at $1,103 and change. Google's currently trading at $10.49, $10.50. So what does it look like from an intraday perspective? Here's the aftermarket or after hours chart. You can see we've already been down as low as the low is 1012.95. 1012.95 is the low. Doesn't look very strong. Looks like it's weak. I don't necessarily look for these stocks to turn around. We're likely to get lower prices tomorrow. Again, the bigger picture is, so what? This is how lows are made. It goes back, it goes forth. The IWM, I'm switching on you a little bit. So looking at the IWM, we had a similar day to the SPY, to the S&P 500, and that's expected. But again, at the end of the day, the same routine happens. So all the markets are going to trade in concert. We talked about that a little bit yesterday, maybe the day before. When situations like this arise, they may not be all up or down to the same magnitude each and every day. But if you have a big down day or a big up day, they're all going to trade together. IWM, triple Qs, SPY, they're all going to trade together. The Dow, it's not going to matter one way or the other. So if we have to come lower in the IWM, and that wasn't a low from yesterday, this is a weekly chart, where are we going? Maybe we come down as low as 142. I'll be a buyer of the IWM down in the 142 neighborhood. 142, 143. Certainly I would be interested down there. It is a real-time decision, but just in advance I would tell you I'm interested and certainly will make the decision in real time. Now here's the VIX. Remember we talked about the VIX yesterday and I said it's interesting and we have to note it. It's a puzzle piece that the VIX wasn't making higher highs as the market was making lower lows. So I don't know if it will make higher highs at all. I just want to note it. I want to be aware of it. And I'm bringing it up again for discussion. The VIX was down 4% when the market was up much, much more on a relative basis. What does that tell you? It tells you that it's likely that the lows really aren't in yet. That's the likely scenario. The transports, again, same chart, same routine, only you'll note the volume today in the transports is slightly elevated from yesterday. So I want to take note of that. I'm interested in that. That's a piece of evidence. It's a clue. It's a puzzle piece. I'm putting it on the table. Still, we may not have found low, but again, all markets don't necessarily turn at the same time. What are the transports? My second favorite market leading indicator. What's the first one? The IWM. Do they have to act in that order? Absolutely not. This could be a potential canary in the coal mine. We'll note it. We'll talk about it again. The triple Qs. Well, we know that the NASDAQ market and the triple Qs in particular is top heavy. Amazon, Google, Apple, all those stocks. So if we have Amazon and Google getting hurt in the morning, if it opens up tomorrow, if they open up tomorrow, similar to where they are now, we know that the NASDAQ market and the Qs in particular are going to get hit pretty hard. It just is what it is. So maybe the lows are in, maybe they're not in the NASDAQ. We'll find out. Remember, this is one of the places, the IWM is another place, but this is one of the places where assets that are destined for more risk go to play. They go to stocks that are destined for growth. You find those in technology. They go in small caps, growth stocks. So what I'm saying here is if the lows are in and we hold up in the technology space, in the IWM, for example, and they begin to support the lows from yesterday, that's one thing. That would be a positive sign. But if they're not in, what would be the next area that I would be interested in the triple Qs? So let's say we broke yesterday's lows. Let's say things got really ugly and we broke down. Where's the next buy zone? Well, let's go to the weekly chart. And the next buy area for me is right around 159, 160. I would be a willing participant at 159, 160 if we broke below yesterday's lows in the triple Qs. Again, it's a decision that'll have to be made in real time, but here in advance, I would tell you I would be an interested party, but will certainly make the decision in real time. Broker dealers, the financials, they were up nicely today, but all in all, there's a long way to go to repair the damage that's been done in the broker-dealer sector. It'll follow the market most likely, as will the XLF. Again, The market is unlikely to go up in a big way or down in a big way without the financials participating. The chart looks very similar to all the others, only there is an exception, and I find this interesting. Look where the high of the day is today. So yesterday's high of the breakdown candle is 25.85. Today's high is 25.84. Is anybody out there under the impression that that's an accident or a coincidence? Of course it's not. The SMH, same routine. All the charts pretty much look identical to one another. Not necessarily all to the same magnitude, but they all pretty much look similar. Same routine. If we're going to get hit again tomorrow, the semis are going to get hit just the same. It's okay. In my opinion, they're giving you another bite at the apple. Gold, not much doing in the gold complex right here. We're above the 100 period moving average. We are making a bullish flag pattern. We're likely going to have higher prices. And let's face it, if we do get another down leg in the market tomorrow, we may see an up leg in gold on the quote-unquote fear trade. That's completely feasible and possible. I'm not a participant in the gold market at this point in time. Crude oil, it's holding the 200 period moving average. We can't really say much more about it than that. You can see what's developing. What's beginning to develop is a bear flag pattern, pretty much the opposite that we just saw in gold. Gold's been making a bull flag pattern for a long time, but we can start to see the beginnings of a bear flag pattern in crude oil. We'll see what happens if it hovers over the 200 period moving average for a number of days. Let's just say another 3 or 4 days. That's the market's way of saying there's probably another leg lower coming. However, on the flip side, you know that logically speaking, under normal conditions, it's going to want to rally up a little bit and at least make an attempt to test near the highs of the breakdown candle. So that's the way I see the crude oil chart. I'm not bullish, I'm not bearish, I'm pretty much neutral crude oil. Here's a curveball. Remember a while ago, it was probably maybe 3 or 4, maybe 5 weeks ago, we discussed where the buy zone is for the bond market. We're looking at TLT, which is an exchange-traded product that tracks really the 20 to 30-year treasury bonds. So it tracks the prices of bonds, which is inverse to yields. So we know all the talk recently was the rise in yields. That was going to be bad for everything. And it will be over the long term. But the more bullish the media got yields, meaning the more they were telling you and the higher they were telling you yields were going, the more likely we were to a short-term top in yields. That's the way it works. The more bearish they get about something, we're looking to buy it. The more bullish they get about something, we're looking to sell it. It really almost never fails. Well, anyway, as they were getting bullish yields, we start to look for opportunities. So we turned to the chart of TLT and we wanted to find where the likely area of support was. Now, at the time, I think we were up in this zone around 115, 116, maybe even as high as 117. And I was saying that we want to look in that zone right around 111, 112, 113, 114. In that zone, that's an area that we want to begin looking to pick up bonds. We looked at a monthly chart at the time, and you'll note that when we talked about the 111.50, but I said you can start them up ahead of time. It's only a couple of percentage points away, whether it's 112.50 or somewhere in that neighborhood. It wouldn't really matter over the longer term because we're likely going to get some kind of a longer term rally, longer term meaning multi-week, maybe even multi-month. And that was a good area with a very good risk-reward scenario. That turned out to be correct. You can see the low was about 112.62, and here we are at 114. It's not a big move yet, but there should be much higher prices coming in the TLT. It's not going to happen overnight. It takes time. So we'll finish up tonight on a chart of the futures. This is the E-mini, S&P E-mini futures contract. And you can see here that we had a pretty good fade at the end of the day. So this is not good news. It's not good information. Likely story is we're going to experience lower prices tomorrow unless they can do some kind of quick fix-it job between now and tomorrow morning. We'll see. There's a lot more earnings coming out between now and the morning. So anything can happen, and certainly Amazon and or Google can turn around and fix the market by themselves. And if you're an S&P E-mini trader, or you want to translate the numbers over to the S&P 500, there are some numbers for you. 2640 is a good area, as well as 2622, 2620, 2625, all the way down, believe it or not, to 2605, 2600 even, is a possibility if we get some real panic out there. And you'll find that those numbers translate to the numbers that we've been looking at on the SPY chart. For the most part, maybe even slightly lower than the lowest number in the SPY chart. But again, we're looking for a low. And with that, folks, I'm going to wrap it here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.